Reuters, 28th of November 2023, mild and optimistic about China-India might dash expectations for a gold surge. A 6-month high for the spot price of gold has been reached on optimism that the monetary tightening in Western nations is almost complete. Although indications that the Federal Reserve of the United States and other Western central banks have completed raising interest rates are encouraging for precious metals, they are not the only ones. China and India account for more than half of the physical gold market. These two Asian heavyweights will undoubtedly significantly impact the future course of prices. Gold is nearing record highs in local currency terms in China and India, and there are indications that this may be beginning to affect retail demand in both nations. Monday saw spot gold hit a 6-month high of $2,017.82 an ounce, up 11.5% from the previous low of $1,809.50 on October 6. Gold's price per ounce in Indian rupees on Monday was 168,145, not far from its record high of 169,401 set on May 4. It has increased by 11.8% from its most recent low of 150,401 rupees on October 6. Although the demand for gold in India has been strong thus far in 2023, mirroring the strength of the country's economy, some impetus may be leaving the market. Amid concerns about weak demand for the impending wedding season, dealers discount soft official domestic prices, which include 15% import and 3% sales levies, doubled to $6 per ounce last week. In China, things are going similarly. Last week, the premium above spot prices dropped from $43 to $58 to $20 to $40 per ounce. Hong Kong imports decreased in October for a second consecutive month, indicating China's demand. Based on data from the Hong Kong Census and Statistics Department, China's net imports from Hong Kong fell 23% to 26.793 metric tons in October from 34.757 tons in September. The leading causes of the weak import demand are probably higher pricing and ongoing economic uncertainties in the greatest gold-consuming nation in the world. Monday's spot gold price in Chinese yuan closed in on the record high of 14,701 yuan set on October 27. It was trading at 14,433 yuan an ounce. The price has risen by 15.7% from its mid-February 2023 low of 12,479 yuan. The high price of gold for consumers in China may further constrain demand in the fourth quarter after the World Gold Council recorded a fall in the third. According to the Council's most recent gold demand trends report, China's demand for jewelry was 153.7 metric tons in the third quarter, 6% less than the 163.2 metric tons the previous year. The Council believes this was a good result, citing the third quarter's record high in yuan terms. The critical question is whether Chinese consumers are willing to keep purchasing gold despite the high costs. Decreasing premiums and fewer imports from Hong Kong point to growing reluctance. Positive drivers out of 3. The same is true for India, where the Council reports a 7% growth to 155.7 metric tons from 146.2 in the same time in 2022, despite the country likewise experiencing a respectable demand for jewelry in the third quarter. It is noteworthy, however, that the third quarter rise coincided with a decline in domestic prices, which had been declining since May until early October. The recent price surge will probably curtail the current quarter's demand increase in India. All things considered, when the 3 main demand factors are cooperating, gold tends to appreciate steadily. These include purchases of investment goods, as evidenced by the increase in gold exchange-traded funds, ETFs, purchases made by central banks, and purchases of jewelry, bars, and coins. Although they have increased recently, ETF inflows are still far below their 2023 highs. The third quarter saw substantial central bank purchases, with 337 metric tons recorded by the Council, the second highest third quarter ever. However, some indications of rising costs impede demand expansion in China and India, two important countries, negating the positive factors. This does not imply that gold cannot rise higher, rather, it may not be as sure a bet as the anticipated conclusion of monetary tightening in Western countries suggests.